These are the biggest financial bubbles in history and the painful lessons they left behind. The first recorded financial bubble began with something surprisingly simple: flowers. In the 1600s, tulips became a luxury symbol in the Netherlands. But this wasn't just admiration, it was obsession. Prices kept rising and rising and rising. Soon, people weren't buying tulips to enjoy them, they were buying contracts to own tulips in the future. Speculation replaced logic. At the peak, a single tulip bulb could cost more than a house. Then, one day, buyers stopped showing up. Confidence disappeared. And within weeks, prices collapsed almost completely. People who believed they were wealthy suddenly had nothing. The world had just witnessed the first major speculative bubble. But history didn't learn its lesson. Fast forward to the late 1990s. The internet was changing everything. Investors believed technology would create unlimited wealth. Companies with no profits, no clear business model, sometimes not even real products, were suddenly worth billions. Stock prices soared on pure excitement. The tech-heavy Nasdaq climbed rapidly as investors poured money into anything connected to the internet. Then, reality caught up. Most companies couldn't deliver real profits. Confidence cracked, and when the bubble burst in 2000, trillions of dollars vanished from the market. The future hadn't disappeared, but the illusion of easy money had. Then came one of the most devastating bubbles in modern history: housing. For years, buying a home in the United States seemed like the safest investment possible. Banks made borrowing easy, very easy. Even people who couldn't afford loans were approved. Home prices surged because demand kept rising. Investors believed property values could only go up, but they couldn't. When borrowers began defaulting, the system started breaking. Financial institutions holding risky mortgage investments faced massive losses. One of the most dramatic moments came when Lehman Brothers collapsed, triggering panic across global markets. This wasn't just a market correction, it was a worldwide financial crisis. Millions lost homes, jobs disappeared, economies stalled, all because a massive asset bubble had been mistaken for permanent growth. And then there's Japan's extraordinary bubble of the 1980s. Property and stock prices exploded across Japan. At one point, land in Tokyo was considered more valuable than entire countries. Investors believed the growth would never stop. But when the bubble burst, asset prices crashed and stayed depressed for decades. The economic shock lasted so long, it became known as Japan's lost decades. So what do all these bubbles have in common? Different countries, different assets, different eras, but the same psychology. Excitement turns into greed. Greed turns into certainty. Certainty removes doubt. And when doubt disappears, risk becomes invisible. That's when bubbles grow fastest and burst hardest. Here is the uncomfortable truth. Financial bubbles don't look dangerous while they're forming. They feel safe. They feel logical. They feel unstoppable. That's exactly why they're so powerful and why they keep happening. Because every generation believes this time is different. But history keeps answering the same way. No, it isn't.